My name is Mike Corbett, and I'm the treasurer of the St. John Region Chamber of Commerce, and it is my honor to introduce to you Tiff Macklem, Governor of the Bank of Canada, for our Leaders, Innovators, and Influential Speakers Series luncheon. Tiff Macklem was appointed Governor of the Bank of Canada effective June 3rd, 2020 for a 7-year term. As Governor, he is also Chair of the Board of Directors of the Bank and a member of the Board of Directors of the Bank for International Settlements. He is Chair of the Group of Governors and Heads of Supervision, the oversights body of the Basel Committee on Banking Supervision, and co-chair of the Financial Stabilities Board Regional Consultative Group for Americas. Mr. Macklem first joined the bank in 1984 and returned in 1989. He occupied increasingly senior positions in what is now the Canadian Economic Analysis Department until his appointment as chief in January 2000. He was appointed advisor to the governor in August 2003 and made a deputy governor in December 2024. During the 2008-2009 global financial crisis, Mr. Macklem was Associate Deputy Minister at the Department of Finance Canada and represented Canada at the G7, G20, and Financial Stability Board. Mr. Macklem returned to the bank in July 2010 when he was appointed Senior Deputy Governor. In July 2014, Mr. Macklem assumed the role of Dean of Rotman School of Management at the University of Toronto. During his time at Rotman, he frequently spoke about the global financial system, risk management, and public policy. Before becoming governor, Mr. Macklem served as a director of the Bank of Nova Scotia and chair of its board risk committee. He was also chair of Ontario's panel on economic growth and prosperity, the federal expert panel on sustainable finance, and the Global Risk Institute in Financial Services. Born in Montreal, Quebec, Mr. Macklem graduated from Queen's University in 1983 with a bachelor's degree in economics. He completed a master's degree in 1984 and a PhD in economics in 1989, both from the University of Western Ontario. Please join me in welcoming the Governor of the Bank of Canada, Tiff Macklem.
Well, thank you, Mike. Look, it's a real pleasure to be here in St. John. One of the most important and most rewarding things I do as governor is travel across this country. It's a great, vast country, and it is wonderful to be able to hear firsthand and see firsthand how our economic policies are impacting the region, get your perspectives on what's going on in the economy and what we can do to make things better. So a big thank you to the St. John Region Chamber of Commerce for having me. It's wonderful to be here today. I am very much looking forward to hearing from you regarding what are the opportunities, what are the obstacles facing your businesses, as well as I said about your perspectives on the economy. And Mike and I are going to have a little Q&A afterwards, and I'm very much looking forward to that discussion. I know that for many people, high inflation has made life hard. We hear it at the Bank of Canada in our surveys of consumers, and I hear it directly from Canadians. I get a lot of letters, I get a lot of emails from Canadians. And too many of these are about the impossibility of keeping up with higher prices. I hear the worry, I hear the frustration, I even hear the desperation in these letters. I also hear from businesses that are being squeezed by higher costs, and I hear from workers that need higher wages to keep up with the rising cost of living. Nothing concerns me more than the pain that high and volatile inflation is causing for so many Canadians and the broader costs it's imposing on the economy. Inflation has come down from its peak of 8.1%, but it is still too high, and progress has been slower than we'd hoped. And I know that even as our interest rate increases are bringing inflation down, to many Canadians, they feel like just another added cost. Ce qui me préoccupe le plus, ce sont les difficultés de la population canadienne connaît et les coûts de l'inflation élevés et volatiles pour notre économie. L'inflation a baissé depuis le sommet de 8,1 %, mais elle reste trop élevée. Et les progrès sont plus lents qu'on le voulait. Je sais que même si nos hausses de taux font baisser l'inflation beaucoup, les Canadiennes et les Canadiens les voient comme un coup de plus. Aujourd'hui, je vais vous parler des problèmes que l'inflation élevée fait vivre aux familles, aux entreprises et aux communautés. Les difficultés sont bien réelles et l'inflation ne ralentira pas d'elle-même. C'est pourquoi il est si important de garder le cap et de rétablir la stabilité de prix. On a déjà fait beaucoup de chemin. C'est l'autre sujet que je veux aborder. Ce qui fonctionne et pourquoi. Je vais expliquer certains des avantages qu'on n'avait pas dans le passé pour lutter contre l'inflation élevée. Les taux d'intérêt plus élevés créent des difficultés pour beaucoup des Canadiennes et Canadiens, mais ils atténuent les pressions sur les prix dans toute l'économie. Si on garde le cap, les résultats vont en valoir la peine. By the numbers, the Canadian economy has done remarkably well. The pandemic is now behind us, and workers, consumers, and businesses have all emerged in much better shape than we feared in 2020. After the deepest and sharpest recession in our history, we had the fastest recovery on record. The job market came roaring back, and even though the economic growth has slowed in recent quarters, the unemployment rate is still relatively low at 5.7%. That's where it was just before the pandemic, when times felt good. The worker participation rate is high, particularly for women and newcomers, and many of us have taken advantage of new ways of working and new workplace flexibility. Many households have added to their savings despite the rising cost of living. But Canadians are not feeling happy. I hear this firsthand. We hear this in our Canadian Survey of Consumer Expectations. We see it in other consumer confidence measures and surveys of public sentiment. Usually, consumer confidence is high when the unemployment rate is low. The blue line in this chart is the unemployment rate. The unemployment rate today is lower and the job market is stronger than it has been for most of the last 40 years. But sentiment, the red line, is at a recessionary low as it was during the global financial crisis in 2008, 2009. So why is sentiment so low? Well, there's probably more than one reason. People are weary from the pandemic, public attitudes are more polarized, reducing the sense of common purpose. Technology is accelerating change, making it harder to keep up, and rising conflicts and climate change are increasing anxiety about the future. These causes are all well beyond the reach of monetary policy. But one factor is clearly our responsibility: inflation. People are angry about high inflation. The rising cost of living is making life harder for everyone, especially Canadians who have less to start with. People are working hard, but their salaries don't buy what they used to. They can't afford the things they need. It feels unfair. And that feeling of unfairness eats away at the fabric of society. There's more disagreement. One metric where we can see this is the amount of time lost to strikes and labor stoppages and work stoppages. The higher inflation in the last couple of years, we're seeing more strikes as employers and workers struggle to reconcile rising costs on each side. Now, nobody wants this. Workers don't want to go on strike, and employers don't want work to stop. But high and unpredictable inflation makes it difficult to agree on fair compensation for work, and that leads to strikes. When inflation is high and volatile, contracts get shorter, negotiations are harder, and uncertainty is higher for everyone. Businesses have also changed the way they set prices for their goods and services, raising prices more often and by larger amounts. That hurts their relationships with customers, raising suspicion and blame. For all these reasons, inflation makes people unhappy. In our most recent consumer survey, almost 9 out of 10 respondents said they feel worse off due to high inflation. Almost no one said they benefit. We're also seeing that inflation is changing people's behavior. We can see in our surveys that families are changing their spending to protect themselves against inflation. They're spending less and trying to find cheaper goods and services. La situation est encore plus difficile pour les Canadiennes et Canadiens à faible revenu. Lorsque les gens dépensent plus pour des produits essentiels, ils ne peuvent pas vraiment ajuster leur achat et ils ont très peu d'économies pour faire face aux hausses de prix. De plus, les prix des produits essentiels comme la nourriture et le loyer sont parmi ceux qui ont monté le plus vite ces derniers mois. Les personnes qui reçoivent une fixe pension sont encore plus touchées parce que leurs revenus n'augmentent pas pour compenser leur prix plus élevé. On a déjà connu l'inflation et les temps difficiles qu'elle entraîne. En effet, les situations qu'on connaît aujourd'hui nous rappellent des années 70. J'étais moi-même adolescent à cette époque, mais pour ceux qui sont trop jeunes pour s'en souvenir, l'inflation alors était élevée et variable. Il était resté au-dessus de 7% pendant une dizaine d'années et même atteint un pic de près de 13%. À ce moment-là, tout comme aujourd'hui, des forces mondiales ont fait monter les prix en flèche. En 1973, la crise alimentaire mondiale et l'embargo sur le pétrole ont fait grimper l'inflation rapidement. My impression as a teenager was that inflation was making everyone angry. There were a lot of labor strikes in the 1970s. Many were long and heated. People felt ripped off because they would get what looked like a good raise, but their money didn't buy what they thought it would when they went shopping. To get inflation down in the 1970s, policymakers tried a few things, including wage and price controls and monetary targeting. Monetary targeting means reducing the growth rate of the money supply. Unfortunately, these policies were ineffective. And the government and the central bank weren't willing to stay the course, to restrain government spending and tighten monetary policy enough to wring inflationary pressures out of the economy. So Canadians lived with high inflation for more than a decade. By the time policymakers realized they needed to take more forceful action, inflation was entrenched in the economy. When businesses, workers, and consumers all expect high inflation, it's harder than ever to bring it down. It took very high interest rates and a deep recession to break inflation. In 1981, the policy rate reached 21%, and mortgage rates were even higher. In 1982, the unemployment rate hit 13.1%. That brings me to what's different today, and why I'm confident we will bring inflation back to our 2% target more quickly and at lower cost than we did in the 1970s. We've learned the bitter lessons from that time, and we've got some distinct advantages today. We've got an inflation target, we've got a strong track record of controlling inflation, and we responded forcefully when inflation went up. Let me start with the inflation target. We began inflation targeting more than 30 years ago. Since 1985, our inflation target has been 2%, the middle of the band of 1% to 3%. Between then and when the pandemic hit in 2020, inflation averaged 1.9% and was within the band 80% of the time, a remarkable success compared to the 1970s and 1980s. For more than 25 years, Canadians benefited from low, stable, and predictable inflation. People understood that when inflation got too high, we'd raise our policy rate and slow demand. And when inflation slumped, we'd lower our policy rate to stimulate demand and growth. That track record and stability allowed households and businesses to budget their spending and savings, confident that their purchasing power would not diminish substantially. Canadians came to expect that prices overall would rise only about 2% a year. As a result, competitive forces in the economy were working. Businesses were cautious about raising their prices, and there was less disagreement, fewer strikes, and less labor disruptions. And the economy was more stable and better able to withstand adverse shocks. That track record matters. Even though inflation rose above 8% last year, and even though it is still above our target, long-term inflation expectations have remained well anchored. It's not all smooth sailing. Expectations for near-term inflation rose with inflation, and they have been slow to come down. And I'll admit this is a concern. We do want to see shorter-term inflation expectations decline to be reassured that we're heading back to our 2% target. But the fact that longer-term expectations remain consistent with the 2% target means Canadians believe that we will bring inflation back to target, as we have for 30 years. The 1970s showed us that the very high cost of entrenched inflation, and we know we need to avoid that danger this time round. That brings me to the second advantage we have. This time, we responded forcefully to high inflation from the start, and we are resolute in our commitment to complete the job. We began increasing interest rates in March 2022 and raised our policy rate more than 4 percentage points in 8 consecutive steps, including a 100 basis point increase in July of 2022. After our rate increase in January this year, we paused to take stock. We were clear when we held our policy rate steady in March and April that we were using this pause to assess whether we had raised interest rates enough to get inflation back to target. When we saw the downward momentum in underlying inflation stall, we raised our rates twice more in June and July, bringing the policy rate to its current 5%. This tightening of monetary policy is working, and interest rates may now be restrictive enough to get us back to price stability. But if high inflation persists, we are prepared to raise our policy rate further. By responding forcefully, we've cooled our overheated economy and taken the steam out of inflation. We also moved quickly to avoid the need for even higher interest rates later, because experience has shown that the slower monetary policy adjusts to high inflation, the more tightening will ultimately be required. This is what happened in the 1970s. Slower action meant even higher interest rates and a sharp economic slowdown at the end. We don't want to repeat that mistake. Economic growth has slowed, and with GDP growth GDP growth has been near zero for the last several months. So now the economy is approaching balance, and inflation has fallen from 8.1% in June of 2022 to 3.1% last month. We expect the economy to remain weak for the next few quarters, which means there's more downward pressure on inflation in the pipeline. In short, the excess demand in the economy that made it too easy to raise prices is now gone. We know that the higher interest rates that are working to bring inflation down are making things more difficult for Canadians, and slower growth doesn't feel great. But the alternative, years and years of high inflation and then a deep recession, would be a lot worse. When we get through this period of slow growth and inflation is back to the 2% target, Canadians will once again be able to budget and invest with confidence. Prices will be stable and predictable, and the economy will work better for everyone. It's time for me to conclude. The past 2 years have been a painful reminder of how much high inflation hurts households, businesses, and communities. It's our common enemy, not only because it creates financial pain and social upheaval, but also because no one wins when inflation is high and volatile. We all want to see high inflation defeated. La plus grande leçon qu'on a tirée des années 70 est que pour faire baisser l'inflation, on ne peut pas faire des choses à moitié. Accepter de vivre avec le stress, les conflits de travail et l'incertitude que l'inflation cause serait une grave erreur. La bonne façon de réagir est de s'engager fermement à rétablir la stabilité des prix. Mais on ne veut pas aller trop loin dans l'autre sens parce qu'on essaie de ne pas répéter la même erreur. On essaie d'équilibrer les risques d'un resserrement trop faible ou trop fort. Si on en fait trop, on risque de plonger tout le monde dans une situation économique difficile. Si on ne fait pas assez, les Canadiennes et les Canadiens vont continuer de subir l'impact de l'inflation élevée et on pourrait être obligé de relever les taux d'intérêt encore plus à l'avenir. Pour que la croissance se stabilise et que l'inflation reste basse dans les années à venir, on a besoin des taux élevés et d'une croissance lente à court terme. Notre cible d'inflation, nos résultats jusqu'à maintenant et nos mesures vigoureuses vont nous permettre de traverser cette période difficile. On est sur la bonne voie et on doit maintenir le cap. The lesson from the 1970s is that fighting inflation half-heartedly and living with the stress, the labor strife, the uncertainty inflation causes would be a huge mistake. The right way to respond is with a firm commitment to restoring price stability. But we don't want to avoid one mistake only to overdo it on the other side. We are trying to balance the risks of over and under tightening. If we do too much, we risk making economic conditions unnecessarily painful for everyone. If we do too little, Canadians will continue to endure the harm of inflation and will likely have to raise our interest rate even higher. To return to low inflation and stable growth in the years ahead, we need these higher interest rates and slow growth in the short term. Our inflation target, our track record, and our forceful response will get us through to the other side. We're well on our way, and we need to stay the course. Thank you very much.
Thank you, Tiff. So questions. I have a handful here now, but there's not necessarily enough to be able to get us through the next part. So please feel free to pencil something down. The staff are in the back and are happy to stop by your table and pick them up and hand them to me here. So let's begin our Q&A session, if we could. We'll also be ending at exactly 1:25. So you're only in the hot seat so long. So okay. So I've got some great questions in front of me so far, Tiff. Thank you very much, by the way. The first question is can you help us understand why central banks are struggling to accurately forecast inflation?
Well, I don't think it's that complicated. You all run businesses. You all work in businesses. I mean, you've all experienced unprecedented volatility over the last 3 years. I mean, our economy went through the deepest recession on record, the fastest recovery. We've had supply chain disruptions. We've got wars. So much of what has happened in the last 3 years is really outside of our historical experience. And with all that volatility, yes, it's been harder than usual to forecast almost everything. With respect to inflation, look, I'll be very candid. We were surprised coming out of the pandemic by the burst of inflation. We did expect inflation would rise, but we definitely underestimated how much and how quickly it rose. And I think there are a couple of lessons from that for us. The first is it's a lot easier to restore demand than supply. Demand came roaring back, but supply just could not keep up. as I say, you run businesses, just trying to hire enough people after you'd been closed multiple times, that took time. That took time to train people. At the same time, globally, supply chains were clogged. You were getting delivery, your deliveries were uncertain. You were having to buy more inventory. All those things added to your costs. Demand was strong. Those got passed on, and prices went up much more rapidly. I mean, the good news is, we got on it relatively quickly. We raised rates forcefully, and it's working. Inflation's come down from 8, came out at 3 yesterday. We're not there yet, but we're certainly well on our way.
Thank you. Tiff, is there anything that the Bank of Canada could have done better to combat this?
Look, I get asked this question a lot of time. Of course there's things we could have done better. I think every one of you running your businesses, there are probably things you look back and think, oh, I could have done that a bit better. As I said, I think to a large extent this inflation, it certainly started globally. We're a very open economy. It was a big part of it was imported. It certainly has become more domestic with the very strong recovery here. We've worked hard to get inflation down. I do think there are some lessons. I mentioned one of them. It's easier to, we underestimated how difficult it would be to get supply to come back. Historically, supply has responded more with demand. We underestimated that. I do think there are some lessons we have to learn. I think another lesson that we've learned or relearned is that, for much of the last 10, 12 years, our economy actually wasn't overheated. It was pretty stable. So we've had lots of supply shocks in the past, but when your economy's not overheated, they've had relatively temporary effects, and they haven't really done much to inflation. But I think one thing we observed is when your economy is overheated and you get a negative supply shock, it does translate into more inflation. So yes, there are lessons that I think that we have to learn from this episode. But I would underline, I do think we got a lot of things right, and I think we're well on our way in getting back to price stability.
Perfect. What are your thoughts on limiting U.S. influence on the economy here?
Well, if it's a more political question, I'll just avoid it. As interpreting it more as an economic question, look, the U.S. is by far our biggest trading partner. 75% of our trade is with the United States. This region is very linked to the United States. To be frank, Canada's very lucky to be situated right beside the biggest economic engine in the world. It's a great benefit to Canada. We always have our differences. We always have our trade spats, but actually we have, with USMCA, we have, a very good trade agreement with the United States. We have very open capital markets with the United States. It's a big benefit to Canada.
Exactly. Given the high value of assets, real estate, stocks, etc., are you concerned that the next decade may be considered a lost decade to allow the economy and values to catch up?
Let me begin by saying I don't give investment advice. No, I'm not expecting a lost decade. I think we've been going through a difficult period. We actually need a period of slower growth that we have right now to relieve these inflationary pressures, to get inflation down. It's working, and as we get through next year, I think we're expecting later next year, inflation will be getting down closer to the target. Growth will be picking up. Look, longer term, we have a number of advantages as a country. We do have some challenges, and we can get into that if you want, but look, whether you're running the country, you're running a business, you need to double down on your strengths and manage your weaknesses.
Understood. What specific economic indicators or measures will the Bank of Canada need to see in order to decide when it's time to cut the interest rates?
Well, that is certainly the question everybody's asking. Let me say two things. Yesterday's CPI number was certainly encouraging. We expected inflation to come down. It did come down, and that is certainly good news for Canadians. I would stress that in the last number of months, we've seen a fair amount of volatility. We've been down to 3.1% before. In fact, last June we were 2.8. It went back up to 4 in August. We're pleased to see it come back down. So there's some volatility, and if you look at sort of the underlying trend or core inflation, what you see is, through the summer into the early fall, it was pretty much going sideways. The number yesterday ticked down a little. That's a good sign. What we're really looking for is clear evidence that core inflation, underlying trend inflation, is down. And as I said, it's been, underlying inflation's been running around 3.5% for some time. There's a little evidence it ticked down yesterday, but look, 1 month is not a trend. We need to see, a number of months to see clear evidence that we're on a path to 2% inflation. When we see clear evidence that we're on that path to 2% inflation, that will be a time to start thinking about cutting interest rates. Right now, it is not time to start thinking about cutting interest rates. We're not, that evidence is just not clear enough yet.
Understood. With many Canadians already struggling with the impact that high inflation has on their discretionary spending, how concerned are you with the large number of residential mortgages that are coming up for renewal, and that there are many Canadians that won't simply be able to afford a significant increase to their monthly payment?
Look, we are acutely aware of the mortgage renewals. So right now, about 40% of mortgages have reset, which means there's about 60 left. Your typical mortgage in Canada is 5 years. There's about 15% are variable rate. And so every month, yes, more Canadians are renewing their mortgage, and when the reset is substantial, and that is squeezing Canadians. It means they've got less income to spend on other things. That is partly how monetary policy works. That is what is reducing spending, and that is what's actually bringing inflation down. So, as I said, we don't want to overdo it. We don't want to squeeze more than we have to. We don't want to make this any more painful than we have to, but we are determined to get inflation down. So we are watching that renewal process very carefully. So far what you see is that Canadians are paying their mortgages. Is it more difficult? Yes, it's more difficult. And that's getting inflation down. It's working. And as I said, when there is clear evidence that we don't have to wait until inflation is back to 2% before we cut interest rates, but we do need to wait until it's clear that we're on that path to 2% inflation. And when we're there, we can start thinking about reducing interest rates.
Understood. You'd mentioned the 70s in your speech, and here's the question as it's read: is some of us remember the stayflation of the 1970s? Are you concerned about the low growth, higher inflation phenomenon?
Well, yes. The word yes. As I said, I was a teenager in the 70s, and the two words that were stagflation and the misery index. The misery index was the sum of the unemployment rate and the inflation rate. There are some similarities today to what we had in the 70s. Burst of inflation, and unfortunately today, there's a whole generation of Canadians that is relearning just how harmful inflation is for the first time. There are some important differences, though, as I highlighted. And what those mean is I am confident that we're going to get inflation down much more quickly than we did in the 70s at much less cost. So, yes, we do need a period of slower growth. We're not predicting a deep recession. We've got very subdued growth. We actually need subdued growth to get inflation down. And as inflation comes down, growth can pick up. So it's not going to feel good, but it's not a recession.
Okay. So a welcome question outside of just inflation is, when will we have a fully functional digital dollar?
Two things I'd say there. First of all, banknotes, cash, is not going away. Canadians like to use cash, and they will be able to continue to use cash. Now, whether we have a digital dollar or not, ultimately actually is a decision for Parliament. It's not a decision taken by the Bank of Canada. What we are doing at the Bank of Canada, though, is that we are getting ready for the possibility of a digital currency. The economy, I mean, I don't need to tell you, you're all running businesses, economy's becoming increasingly digital. There are more digital payments options. And at some point, it may make sense for Canadians to hold central bank currency in a digital format, just like they hold central bank currency in a physical format. So we're getting ready for that possibility. There are a lot of policy questions related to that. How would that work? What impact would it have on the financial system? What do Canadians want in a digital currency? Actually, we've recently surveyed Canadians to get out their attitudes about a digital dollar. And we'll actually be publishing the results of that fairly shortly. But just to preview it, I mean, one of the things, not surprisingly, you hear from Canadians is very concerned about the security and the privacy that would be involved in a digital dollar. So those are the types of things we're looking at. And we've certainly got some work to do. And as I said, ultimately, it's a decision of Parliament.
Okay. How will increase in wages of union groups impact the go-forward inflation? Is it material or significant?
So, first thing I want to stress is that we really like to see higher wages. That's higher incomes. That's good for Canadians. But what we want to see is that those higher wages come with higher productivity growth. Higher productivity pays for higher wages. So when we look at wage growth, we're really looking at wage growth relative to productivity. Right now, wage growth is running around 4 to 5%. The labor market, which was quite overheated, we were experiencing a large number of labor shortages. Companies were having a very hard time finding enough workers. The labor market has come back into much better balance. It's probably still slightly on the tight side. Depends a bit on the sector. It depends on the type of worker. But on balance, it's probably still slightly on the tight side. But if you look at vacancies, they've come down. They're still a little above normal, but they've come a long way back. The unemployment rate has moved from very low levels back up to 5.7. So you're seeing that adjustment. And with that adjustment, we expect to see some deceleration of wage growth. And the reason is that wage growth at 4 to 5%, unless we see a big pickup in productivity growth, that's not consistent with 2% inflation. So we are looking for some gradual easing in wage growth. We're also looking for some pickup in productivity growth. Together, those will bring unit labor costs down more in line with our inflation target. So that is something we are watching for.
Thank you. Just time for another couple more questions if we could. Beyond interest rate adjustments, what tools does the Bank of Canada have to make monetary policy? Have they been used to reduce inflation properly, and if so, how?
Our interest rates really are our primary tool. When the economy is really weak and inflation is falling, we lower interest rates, stimulate the economy, support the economy, and push inflation back up. And as you've all seen recently, when the economy is overheated, inflation's rising, we raise rates. That's our primary tool. We do have some other tools that we use more in exceptional emergency circumstances. So during the pandemic, when our interest rate was as low as it could go and we couldn't lower it anymore, we used something called quantitative easing by government bonds in scale, which pushes interest rates further at the yield curve down. Now we are unwinding that. We're doing something called quantitative tightening. So our balance sheet is shrinking, which on the margin tends to push longer term interest rates up a little bit. But I would really stress that our primary tool is our policy interest rate.
Understood. How big a factor are gas and fuel prices as opposed to excessive consumer spending on inflation?
Well, certainly energy has been a big part of the inflation cycle. We've seen energy prices were going up already as the global economy was coming out of COVID very quickly. And then, of course, Russia's unprovoked attack of Ukraine boosted global energy prices dramatically. That was an important reason why inflation went up to 8%. And as energy prices have eased, that has been an important factor bringing inflation back down. We don't, although we are an oil producer and certainly oil's important locally, oil in Canada is priced at the global price. And so our consumers pay the global price, and when global prices go up, that shows up very quickly in CPI inflation. It shows up very quickly at the gas pump, in your heating costs, so it shows up very quickly in inflation. That's not something we can control, and to the extent that it's not feeding through into other prices and wages, it's something we largely look through. There's going to be volatility in oil prices. What we're more focused on is underlying inflation, our measures of core inflation that tend to strip out the volatile components, often, which is often oil, because that gives you more of a sense where, what's the underlying trend in inflation, and monetary policy works with a lag, so you don't want to overreact to every movement. But I will say, if what we're worried about are the second round effects. So if oil prices were to go up a lot, particularly against a background where we've been above our inflation target for 2 years, we would be particularly worried about the second round effects. If oil prices go up, transportations go up, that starts to show up in the prices of other goods and services. That would certainly be a signal of trouble for us. Hopefully that doesn't happen.
In your opinion, what is the biggest misconception the public has on the Bank of Canada and the job it does?
That's a good question. One thing I think, and we're trying to do a better job of explaining it, is I think everybody understands they don't like high inflation. People don't like higher interest rates either. I think one thing we're trying to explain more clearly is the link between how higher interest rates get inflation down. And then once inflation is down, interest rates can come down too. But we do need this period with higher interest rates, with slower growth, to get inflation down. It's not going to come down by itself.
Thank you. Last question. Sorry, there's many more here, and these are great. And I wish I had you for another hour, but I'm sure sitting in a hot seat for an hour is not overly attractive to you. But to wrap up the session, the question that came forth, what advice do you have specifically for business, but not just business in general, but business in New Brunswick? What advice do you have for the membership here on how to survive, how to succeed during these tough economic times? What specific advice do you have?
Look, I hesitate to give business advice. You know your businesses much better than I do. But I think just a few sort of general comments about what we're seeing. Canadian businesses have shown incredible resilience and innovation through the pandemic. You quickly figured out how to serve your customers, how to get your employees to work from home. This pandemic would have been so much worse if it was not for the resilience and the ingenuity of businesses. And as we have come out of the pandemic, we're not talking about pandemic level challenges, but yeah, there are new challenges. And if I was to offer one bit of advice, take some of that spirit of innovation and ingenuity and apply it, every day. We have some amazing companies, highly productive companies in this country that are competing extremely effectively in the global marketplace. Wouldn't it be great if we had a few more? And I think if we bring that spirit of innovation, that sort of desire to figure out how to drive out cost, how to create new products, how to expand new markets, we will have more world-leading companies.
Well, thank you very much, Tiff. Well, and thank you on behalf of the Chamber of Commerce for coming to St. John to share your message, to bring the message of the Bank of Canada and informing us right directly from you. So I'd also like to thank today's Speaker Series sponsors, Envision St. John, Emera New Brunswick, Liberty Utilities, University of New Brunswick St. John MBA program, CHSJ Country 94 and 97.3 The Wave, and Fusion St. John. Thank you all for attending, and this meeting is now adjourned.